For about 2 years now, there has been this specific feeling that a lot of investors have been carrying around. You watch Nvidia go up 200%, then another 100%. You watch Palantir triple. You watch every earnings call from every major tech company turn into a competition for who can say the word AI the most times. And the whole time, you are sitting there thinking, should I be buying this? Am I already too late? Is this a bubble? And if it is not a bubble, what exactly am I supposed to buy? If that feeling is familiar, this video is for you.
Because the conversation around AI investing has two speeds, and neither of them is actually useful. Speed 1 is pure hype. AI is going to change everything. Buy Nvidia, buy Palantir. The gains are just getting started. Do not miss this. Speed 2 is pure doom. This is exactly like the dot-com bubble. Valuations are insane. It is all going to crash. Get out now. Both of those framings skip the part where you actually understand what you are buying and why. That is what this video is. Not a list of stock tickers. A framework for thinking about AI investing that you can actually use to make your own informed decision. I spend way too much time thinking about investing, market structures, and the gap between how exciting a technology is and whether the stocks attached to it are actually good buys at a given price. If that is the kind of thinking you want more of, subscribe and give this a thumbs up. Let's go. First, let's talk about what has actually happened with AI so far, because the numbers are genuinely extraordinary, and understanding them matters for everything that comes next. Nvidia went from being a gaming chip company to controlling somewhere between 80% and 90% of the AI training chip market. Its data center revenue, which is almost entirely AI-driven, now represents more than 80% of its total revenue. The company's revenue growth over the past 3 years has been one of the fastest in the history of large-cap stocks. That is not hype. That is real revenue from real customers spending real money. Microsoft deepened its OpenAI partnership and embedded AI, it calls it Copilot, across its entire product suite. Azure, Office, GitHub, LinkedIn. AI services on Azure are growing faster than the core cloud business. Meta reached 1 billion monthly active users for its Meta AI product in 2025, and its advertising revenue grew 33% year-over-year in Q1 2026, driven significantly by AI improvements to its ad targeting. Alphabet is planning $180 to $190 billion in capital expenditure in 2026, most of it aimed at AI infrastructure. McKinsey projects AI infrastructure to become a $7 trillion market through 2030. And as of mid-2026, the capital expenditure from Microsoft, Google, Amazon, and Meta is still accelerating, not decelerating. So the AI story is real. The revenues are real. The investment is real. That part of the bull case is not in dispute. The only question that actually matters for you as an investor is whether all of that reality is already priced into the stocks. And to answer that question properly, you need to understand that AI investing is not one thing. It is 3 very different things stacked on top of each other. The first layer is what people in finance call picks and shovels. During the gold rush of the 1840s, the people who got reliably wealthy were not always the gold miners. They were the people selling the picks and shovels to the miners. The people who made money regardless of which mine struck gold and which one came up empty. In the AI gold rush, the picks and shovels are the chips and the infrastructure, the companies making the hardware that AI runs on. Nvidia makes the GPUs that train AI models. No one has seriously challenged their dominance in this space. TSMC manufactures the most advanced chips in the world. Nvidia, AMD, Apple, Broadcom, and the big tech hyperscalers all depend on TSMC. Its 2-nanometer manufacturing node is already sold out through 2026. Broadcom supplies custom AI accelerators to companies like Google and Meta, and its AI semiconductor revenue is projected to double year over year in 2026. These are the infrastructure layer.
They make money as long as the AI build-out continues, regardless of which AI application ultimately wins. If Nvidia's chips power the AI that beats every other AI, Nvidia wins. If a completely different model architecture takes over, the chips still had to be trained on something. The picks and shovels layer is the least speculative way to invest in AI. It is also the most expensive right now. Nvidia trades at a significant premium because everyone knows about it. TSMC is arguably cheaper relative to its role in the supply chain. It trades at around 24 times 2026 earnings, despite being the essential bottleneck for every advanced chip in the world.
The second layer is the platform layer. These are the companies that own the infrastructure on which AI gets deployed at scale. Microsoft with Azure and its OpenAI partnership, Alphabet with Google Cloud and its Gemini models and its own AI chips called TPUs, Amazon with AWS and its Trainium and Inferentia chips and its deep investment in Anthropic, Meta with its advertising platform and the AI that increasingly drives it.
The platform layer is interesting because these companies are profitable today, genuinely profitable, not just on an adjusted basis, and they are investing enormous amounts of money in AI from a position of financial strength. Meta trades at just 20 times 2026 earnings, despite 33% revenue growth in Q1. Alphabet trades at around 29 times forward earnings, with 22% revenue growth and a 36% operating margin. These are not expensive valuations for companies growing at these rates. The platform layer is arguably the most attractive part of the AI landscape for a long-term investor who wants real earnings rather than pure speculation. The third layer is the speculative layer. These are the pure-play AI companies that are growing fast, spending more than they make, and betting that the enormous revenue of tomorrow will justify the enormous losses of today. CoreWeave is the clearest example. Revenue went from essentially nothing in 2022 to $5.1 billion in 2025 and is expected to exceed $10 billion in 2026. That growth is extraordinary, but CoreWeave is deeply unprofitable. It carries heavy debt and massive capital expenditures. And 67% of its revenue in 2025 came from a single customer, Microsoft. If Microsoft ever decides to bring more of its compute in-house or diversify its suppliers, CoreWeave's business changes overnight. Palantir is another name in this layer. Its AI platform has real customers and real revenue, but the stock trades at a valuation that assumes years of near-perfect execution. This does not make these companies bad investments. It makes them high-risk, high-reward investments, where the outcome is highly sensitive to assumptions about the future that nobody can make with certainty. Now, the bubble question, because this is the question everyone is actually asking, and most content around AI investing refuses to answer directly. Are we in an AI bubble? The honest answer is maybe. And the reason that answer is honest rather than cowardly is that the evidence genuinely points in both directions. On the bubble side, most economics professors surveyed by NerdWallet in late 2025 said yes, we are in an AI bubble, and many cited parallels between the current AI boom and the dot-com bubble of the late 1990s. The valuations of some pure-play AI names are extreme. The late June 2026 tech sell-off showed how quickly AI enthusiasm can reverse when sentiment shifts. And the fundamental question of whether AI applications will generate enough revenue to justify the trillions being spent on AI infrastructure has not yet been answered. On the not a bubble side, the revenues are real in a way that dot-com revenues were not. Nvidia is not a company with a vision and no sales. It is a company growing revenue at extraordinary rates with genuine profit margins. Microsoft and Meta and Alphabet are not speculative bets. They are profitable businesses growing faster because of AI. The infrastructure investment is being funded by companies with real earnings, not by venture capital money burning through losses, hoping for an eventual profit. The bubble concern is most valid in the third layer, the pure play speculative names. It is least valid in the first and second layers, where real revenues exist, and in some cases, real earnings. Here is something that most people do not know, but absolutely should before they spend a single dollar on individual AI stocks. If you already own a simple S&P 500 index fund, you already own the biggest AI stocks in the world. Nvidia, Microsoft, Alphabet, Meta, Amazon, they are all in the S&P 500, and they are all large positions in it. If AI takes over the world and these companies benefit enormously, a significant portion of that benefit flows directly to your index fund. You may have more AI exposure than you realize without having done anything. This matters because it changes the question slightly. The question for most investors is not whether to have AI exposure. You probably already do. The question is whether to add concentrated individual AI stock positions on top of your existing index fund exposure. And the answer to that question depends on your risk tolerance, your time horizon, and your honest assessment of whether you have genuine insight into which AI companies will win, or whether you are mostly riding momentum and hoping for the best. If you want additional AI exposure beyond what your index fund already provides, the cleanest way to do it without picking individual winners is through an AI-focused ETF. Options like the Global X Artificial Intelligence and Technology ETF or similar vehicles give you diversified exposure across the entire AI supply chain, chips, platforms, and applications, without betting everything on one company getting it right. If you want individual stocks, focus on the layer that matches your risk tolerance. Infrastructure layer, Nvidia, TSMC, Broadcom. If you believe the AI build-out continues regardless of which applications win. Platform layer, Microsoft, Alphabet, Meta. If you want AI exposure with real earnings and reasonable valuations. Speculative layer, CoreWeave, Palantir, and whatever comes next. Only if you genuinely understand the specific risk of each company and can afford to be wrong. And whatever you buy, the position sizing matters more than the stock selection. Having 3% of your portfolio in Nvidia, even at today's valuation, is a reasonable speculative bet. Having 30% of your portfolio in Nvidia is a bet that requires near flawless execution on the bull case to justify. The AI story may well play out exactly as the bulls predict, but even correct predictions about the future can result in poor investment returns if you pay too much for them up front. The most important thing about AI investing that most people get wrong is this. They focus on which technology wins and ignore what they pay for it. The technology question and the valuation question are two different questions. You can be completely right that AI is transformative and still lose money if you buy the stocks at prices that already assume that transformation has occurred. Think about it this way. If everyone already agrees that AI is going to be enormous, and at this point in 2026, pretty much everyone does agree on that, then the stock prices of AI companies already reflect that consensus. The remaining question is not whether AI is big, it is whether AI is even bigger than the prices already imply. And that is a much harder question to answer. That does not mean avoid AI stocks. It means buy them with clear eyes about what you are actually paying for. Own the infrastructure layer if you want the most reliable picks and shovels play. Own the platform layer if you want AI exposure with real earnings and real margins. Own the speculative layer in small amounts if you want the highest potential returns with the highest potential losses. And if you are not sure, your index fund is already doing some of the work for you. Sometimes the best investment decision is the one you have already made.